Hey everyone, it's Imran from Options Insight, your macro options spotlight. Remember, like, subscribe, comment, ask questions, do whatever you like, but we want to get the algorithm passing this around so people can learn about options and learn this information. All right, so US stocks continuing their squeeze into the CPI due out today. As the whisper is for another miss from consensus. So we've seen that a few times now. Looks like it's becoming a bit of a trend, and all the people who kind of analyze these numbers and really come up with the predictions are calling for another miss. So let's see how that plays out. Most other regions also rallied, with only really India lagging small down, but everything else pretty much up, anywhere between half and 1 standard deviation. Precious metals, on the other hand, you can see were lagging. They were down, whereas the more cyclical commodities like energy, like copper, etc., were still continuing their ascent, along with what's happening with China. Really, that China trade starting to take hold and really starting to drag up some of these commodities with it, particularly copper, which is now clearly broken out above that $4 level quite convincingly, up 11% on the week, and that's about a 3 sigma move for copper. So really decent move up there. In terms of vol, the only real standout in vol is China vol was down quite a bit. That's down 6 vols on the week now. So, that's obviously had a big, strong move up in recent months. But now the options market is saying, okay, we may well still continue to rally, but it's going to be more orderly from here. So that's why they're starting to bring the vol down a bit. In terms of carry, still pretty positive across the board here. US about 20%. Eurostock still negative, China's still negative, but those numbers are getting smaller. The implied move for today is around 2% for the S&P on CPI, which to me doesn't really sound huge. I do suspect there's going to probably be more intraday vol than there's going to be close to close vol. That means the market's going to move around quite a lot, swing around quite a lot. It might mean revert back to zero by the end of the day, but it might have a big knee jerk, similar to what we saw on the last CPI. But that's kind of what I'm anticipating. Probably more so to the downside. If we get a knee jerk down, I wouldn't be surprised if buyers came in. If we go up, I think we're probably going to stay up, but that's my personal bias right now. Okay, all eyes on CPI. That's the main event. As we said, a lower CPI is expected now. It seems like the whisper definitely is for that. And markets already rallied about 2.5% this week in anticipation. This does suggest that a larger move would probably come from a higher CPI print that no one's really expecting right now. So we do agree that the knee-jerk move would be lower. It'd be in the order of magnitude of 2 or 3% if we did get a high print. But then we also think that the market's going to look past that, as it's more about the labor market in terms of the Fed reaction function, because inflation has peaked. That's what the market seems to think. And so we think there'll be call buyers who come in to take advantage of any dip that we see. That's my sense on this right now. So we'll be looking out for that 0 DTE call option flow if we were to get a knee jerk lower, because remember that the print's going to be at 1:30 and the market doesn't open until 2:30. Now, if the print does come in light, then we think we're going to knee jerk to probably somewhere between 40.50 and 4100, or get there by the end of the day, let's say. That's where the next sort of resistance zone is likely to be. And we'd be taking out that 4,000 area pretty sharpish. The 200-day moving average is also around these sort of levels. So we do think that would probably bring in some buyers as that technical break occurs. Now, we are likely to get some pushback from Bullard, who's due to speak later today. So if the market rallies too strongly, he's probably going to come in and give you some pushback there. But ultimately, we think the first look at bank earnings tomorrow is going to determine how we close out the week. Now, the last thing I will mention is Europe really putting in some stellar outperformance recently, to the point where it's becoming statistically significant. So if we look back here at 50-day return spread between Eurostoxx and S&P, going back quite some time, all the way back to the year 2000, you can see this type of outperformance is kind of getting pretty extreme now. So that suggests that this outperformance of Europe needs to take a bit of pause for breath. And if it does that, one way you might want to express that is Eurostoxx and DAX puts that have not been this cheap in a very, very long time. Both the implied vol is low and the skew is low. So if you're looking for a short-term pullback in these things, then it's an opportune moment. Okay. Moving on to my main topic of the day, which is HYG. So high yield credit spreads. Okay, where do these things typically go in recession? So even though the market right now isn't suggesting that recession is right here and we may need to wait a few quarters, it does seem inevitable that we are going to get one this year. Okay, and most people would agree with that. Now, if we look at the chart from the Fed here on high yield credit spreads going back 20 years, it shows you in the shaded area that in every recession that we've had in the last 20 odd years, more than 20 years, these high yield spreads have got to at least 8%, and in some cases 10%, and in one case even 20%, which is massive. And currently they're sitting at around 5%. Okay, so they've got quite some way to go if we were to go into a recession, based on history. Now, we also think that credit in general isn't going to be quite as squeezy as equities, right? Because we've got some very beaten up sectors in equities like tech, like growth tech, and these things can have some pretty sharp, impressive bear market rallies as we wait for the reality of the recession to set in and for corporate earnings to roll over. So whilst we're waiting for that, who's to say the NASDAQ doesn't want to do a 10% squeeze, right? So, or more even, right? So I would be less inclined to be shorting stocks, but putting on structural shorts in things like HYG to get ready for what we think is an oncoming recession seems to line up a bit better from my perspective. Now, looking at the HYG vols, so since we've had this bounce in HYG, so here's the chart on HYG. We've had this run up from near 72 up to 76. It's broken. This downtrend has been broken. So we may well then need to test 77 or even near 80 as the next big resistance levels. But as we've had this run up, typically you would expect vols to come down. Now, when we initially sold off, remember we had that big move from here, 77 down to 72. And that was 2-3 months ago. When that happened, we had a pretty steep ascent of vol, right? Vol went from around 14 up to 19. So you can see in these red and yellow dots, that was quite a steep ascent of vol as spot prices were going down. But if you see in the last month, as we've rallied from this green dot to up here where we are now, the green dots are quite shallow, which is showing you that vol is refusing to go down very much as the market's rallying, right? And we suspect that the market is putting a bit of a floor on implied vol on HYG somewhere around this 10-11 level, right? So we think vol's going to float to some extent if we were to continue to rally. So we don't really see, and we do think skew, if you look at the steepness of the skew, it has been flattening quite considerably. So, it's in the lower percentiles now if you look at HYG skew. So they battered the skew, the vol's been down here at 11 and it's refusing to go lower. That suggests that owning some volatility is starting to look more interesting at this current juncture. Okay, so moving on to our dashboard. What do we see on there? On our vol dashboard, HYG, the strategy compass is spitting out bearish risk reversals because whilst the vol has retraced, if you look back, a year or two, this vol has traded as low as 5. Okay, so we're not near the lows, but we are near local lows, right? If we look at most of last year, the floor has been closer to 10. So if you think if we're going to go back to the old lows of 5, then clearly vol looks a bit expensive still, right? I personally don't believe that. I still think there's not enough economic volatility under the hood to keep a bit of a floor in this vol. So I think we're near the lows in vol. Okay. So I'm not that comfortable on this potential breakout. If you look at spot here is at the top of the Bollinger Bands, but if it breaks out, it could have a charge up to this next level. So I don't necessarily want to be short calls as part of a bearish risk reversal at this point where there's breakout risk. Okay. And I also think equity markets could potentially squeeze from here as well. So for me, bearish risk reversal is not the no-brainer trade here. I do think vol's quite cheap. Looking at a term structure, the fact that the term structure is so flat, I would much rather park myself in June out here than be in the short dates because the realized vol isn't amazing. The realized vol, there is still some carry there to harvest in terms of realized coming in under implied. So if we were to go range bound and not really do much, the front end of the curve could collapse. So owning February or March could hurt you as this part of the vol curve shifts lower. That's possible. But I do think the June part of the curve is going to hold up much better. It's already priced at 11 and a half. So I don't think it's got loads of downside from here. So for me, the best expression right now, also taking into account that the skew has cheapened up, you can see here, is to just buy outright puts. So I'm not ready to sell calls. But I think we are a bit stretched in terms of spot, but I know we could break higher. I think the medium-term vol is pretty good value, so that's where I'm landing. I'm landing on buying outright puts. Which puts would I buy? All right, guys. I hope you understand what I'm talking about, and obviously hit me up in the comments and stuff if you've got any questions. Thanks for listening, and I'll catch you guys tomorrow.